Welcome to Share Views, and I'm joined by Rajan Dhall from TradingView and London South East. How are you today, Rajan?
Not too bad, thanks for having me, Zach.
Well, I've described you as somebody who's a younger, cleverer, better-looking version of myself, and I have to say, I can't believe that you're younger than me.
In the past, you have described me as that, yeah.
Yes, so does that help you with the financial markets at the moment?
No, I think it scares people off.
Right. So, I mean, we've just had, we had the election, we've had a rate rise in the US.
Yep.
We've also had, I suppose, a lack of any bazooka from Trump on tax or infrastructure.
Yep.
How do we play all this?
Okay, I mean, the first point of call for me from a UK equities point of view was post-election and also with the Queen's speech, been closely looking at some of the utilities names, SSE, for example, and there was a question mark on whether PM May would be able to get her views across and get all the stuff from her manifesto getting actually through in passing. But obviously throughout the Queen's speech we actually heard about the energy price cap and we saw SSE shares fall at the same time. So I was particularly interested in that yesterday. Do
you think they'll be able to get, I mean, Theresa May, you know, obviously to give the Queen something to say, I mean, she's got to put something in there, but in the speech, but basically we don't even know whether there's going to be enough members of Parliament on Theresa May's side to get anything across.
No, I fully agree. But I think if you're looking at, I suppose, how the rest of the members of Parliament will look at energy and the fact that it might be too expensive and sometimes their margins are increasing and bumper pay packets for...
So it's a vote winner. Basically.
Exactly, that's what I mean. I think across the board, I think everybody will accept this one, especially on the energy prices, and that's why I was keen in keeping an eye on SSE. But one thing that everybody does have to be aware of is how much the move would be priced in already. So I do think share prices will still fall a little bit, but I do think there is a cap on how far it will fall. I don't think it's just going to continue forever. It was gone a little bit lower than the value area right now, and I'm looking at maybe 2-3% more.
Right. One other thing things about investment, maybe you can comment on, is it's in my mind with these sorts of companies, these sorts being utilities, etc.
Yeah.
Don't get mad, get even. They're yielding what 5-6% in many cases. Yeah. You're losing on your gas bill.
Yep.
But just buy Centrica, buy SSE, buy all these companies because. Your loss on your bill is their dividend. Yeah,
exactly. I suppose it's like a hedge play, for example, on your gas energy cost. But yeah, I do fully agree. And along with that line as well, I've been looking at Next. So Next, they fell off a cliff when I suppose the elections and Brexit and the softer pound, etc., etc. But the thing is that they keep their dividend yield quite high, don't they? Yeah. So I think that kind of offsets some of the problems. I mean, I do think maybe retail will struggle a little bit more, but I think it's quite a good play to do that. But how long is it sustainable to keep those dividend yields so high while sometimes high street names are struggling? So that's a good example of that.
But maybe it doesn't matter in the sense that even if they get rid of, I don't know, 1% or 2%, you're still looking at something which is much better than being in the bank, and that's the issue with the market at the moment. I mean, many of these leading stocks, even with the FTSE at record levels, are still have good yields.
Yeah, exactly. I mean, that moves us nicely onto interest rates and what's going on with financials, doesn't it? I think the interest rate rise of 0.25% and maybe sometimes a slightly hawkish Fed, talking up the dollar every so often. I think, that does happen. You're not yielding much in savings accounts, across the pond or here. So everybody are going to look for the high yielding stocks to counteract that and manage their portfolio and shift their portfolio paradigm in that direction of yield. Yeah. So I have been looking at the yielding stocks. Yeah.
Right, and in terms of any sectors in particular, I mean, what's attractive at the moment? It's a tough call, isn't it?
Very tough call. I mean, I think financials have still got a little bit of way to go. I mean, we're looking at Barclays share price was falling a little bit, RBS a little bit in trouble. All of these scandals with these guys paying off people in Qatar, that kind of thing. But once we get through that, I am bullish financials again, because I do think that it's time that people do start to normalize interest rates again. Central banks do start to normalize. So I know it's going to be a slow process, but every time it does, we do see financials increase again. But another sector I've been looking at is the commodity sector. So companies, BHP Billiton, Anglo American, all of these guys, they've been suffering with low iron ore prices. So that's a big deal, especially for BHP Billiton. And I do think that sometimes the market can tend to overreact. And I think they'll pull back sort of towards the mean value and maybe continue the upward trend that we've seen for a lot of this year.
But that's the thing. I mean, I suppose so far in 2017, without the Trump the Trumpflation trade getting any momentum, let's say, you've been trying to catch a falling knife with these Anglo Americans, Billitons.
Yeah.
How will we know if the game's up?
I think everybody lost a lot of credibility with Trump. Like as soon as I suppose the repeal of Obamacare, that fiasco, that saga, kind of came to light. But eventually, we're going to get to a point to see whether this is going to happen or where it's not. And I think placing your money in those shares at the time where it's closer to that decision being made, I don't think you're going to get anything at that stage. I think the trade might have already been done. So I think maybe trying to edge for it slightly before and playing the risk to reward play rather than waiting for it to get done. So the risk to reward is obviously going to be a lot nicer when everybody thinks it's in a bad situation and Trump can't get that done. So maybe trying to catch it slightly early might benefit you on this particular trade, but we have to wait and see for that.
Right. I mean, is that more in a way a dollar play or a currency play?
Exactly that. Yeah. I mean, just the other day when I suppose we get conflicting stories from central bankers of whether their currency is too low, whether it's too high, whether one inflation reading is just a blip, because that's what we heard from Janet Yellen after the FOMC, that yes, they raised rates and not to worry about one poor inflation reading. But the thing is that with inflation, it's these oil prices, I think. So that's the key problem I think they have, and it's the oil prices that have given them a problem, but that's also the US's fault with shale, the rise of shale. So I think the US maybe have to internally sort that situation out. Maybe Trump or whoever's putting some pressure on some of the shale producers or something like that for maybe or give oil a bit of space for a price rise.
But isn't that the best scenario for the US economy? I mean, they're getting they're getting oil out of the ground for like $5 a barrel. That's great for the economy. That in a way that's an reflationary type of trade there for the US, and that can only help them.
Of course it is, but the key theme across the world is stagnation in wage growth, right? So for them to actually be able to put interest rates up comfortably, inflation has to be controlled somehow. And me being a bit of a conspiracy theorist, I think they're going to have to put some kind of pressure on the shale producers for that to be induced. But then also, that aspect of things are correct. I mean, it is producing a lot of revenue for the economy, so that is going to induce spending. But it's going to take too long, I think, for this next interest rate rise, which is coming before the end of the year. I think we're only going to see one more before the end of the year. But I think they have to put pressure on inflation for it to get there.
Right. Any insight on Europe? Because obviously you've got Macron there, as a sort of clean slate. He's wiped the floor with his opponents, totally in charge. Yeah. That seems to be really helping the euro and the eurozone at the moment.
Yeah, I mean, I've got a tentative target of 116 for euro, but moving forward towards the end of the year, I do believe we're going to see some more political tensions coming from Italy. So, I'm a frequent visitor to Italy, and you do see a north-south divide on, a lot of people, I suppose, being upset. Saying that the north has too much money and the south doesn't get enough anything, or the producers of products down there don't receive enough money for their going. So I think that's going to be the next political problem. So that's what I'm waiting for. I think we'll see a push maybe to 116, highest 117, 118, and then I do think when that political issue comes to the fray, I do think we might see a sell-off, because at those levels, with that hanging over them, maybe euro would be a little bit overvalued there.
Okay, well, that's it for today's share views. Thank you to the Rajan Dhall from TradingView and London South East.
Thank you.